Yesterday, March 19th, the stock market rallied after a majority of Fed members maintained a forecast that the federal funds range will be 50 basis points lower by year end than the current range of 4.25 to 4.5%. If that forecast proves accurate, money market funds and short term T bills and CDs will be 1/2 of 1% lower in yield starting next year, early next year. I have to take the forecast that the Fed is now making seriously when making decisions on whether to lengthen my bond duration. I have been buying more bonds maturing after 2027 this year. The Fed did make a monetary policy easing decision in its announcement yesterday by reducing the maximum runoff its Treasury holdings to $5 billion per month from $25 billion. That means the Fed will be reinvesting more proceeds from maturing Treasuries into new purchases, which I would call a light form of quantitative easing, while others might label this change in monetary policy as less quantitative tightening. At the height of the quantitative easing period, the Fed balance sheet went over $9 trillion, and that was inconceivable to me as even being possible prior to 2020. The Fed's purchase of treasuries and mortgage backed securities were financed by money creation by the Fed. M2, a broad measure of money supply, was at 15.483 trillion in February 2020, just prior to the pandemic caused recession, and hit a high of 21.724 trillion in March 2022, or about a 37.4% increase in the money supply over a 2-year period. Many economists believe that inflation is primarily a monetary phenomenon, and that may very well be the case when there are other upside inflationary factors present like the supply chain problems that existed in 2021 and 2022, coupled with a fast acceleration in consumer demand resulting that were caused by a variety of factors. What seemed to have been forgotten quickly yesterday was that the Fed increased its inflation forecast for 2025 and decreased its real GDP estimate as well compared to its previous forecast made in December prior to the initiation of the Trump tariff taxes, which will slow GDP growth this year and increase inflation. The Fed reduced its real GDP projection for 2025 to 1.5 to 1.9% from 1.8 to 2.2%. So that's a significant reduction in its forecast. The projection for personal consumption expenditure inflation was increased to 2.6% to 2.9% year over year from 2.3 to 2.6%. Core PCE inflation was increased to 2.7 to 3% from 2.5 to 2.7%. Trump, in effect, acknowledged yesterday that the tariffs would lower GDP growth this year when he commented that the Fed needed to lower interest rates when the taxes started to kick in. The relationship of Trump's tariff taxes to decreased growth and more inflation will be lost on many of his supporters, since Trump has repeatedly told them that the U.S. tariffs are paid by foreign countries, when they are in fact paid by U.S. importers to the U.S. Customs Bureau and then passed on to the U.S. customers when they purchase products in the United States. My personal opinion is that the Fed was still underestimating the hit to real GDP growth caused by the Republican policy changes in Washington, and is underestimating the inflationary impact of those policies as well, provided those policies continue through the year or most of it. The Fed projected in December 2020, and this just shows you how far off their projection can be, that PCE inflation would be 1.8% in 2021 and at 1.9% in 2022 and 2% in 2023. And those projections were made in its December 2020 forecast. Way off compared to the actual numbers. The mass deportations are likely to continue into 2026 and beyond, and Americans will find out starting in a few months how that will disrupt the U.S. supply chain, primarily in agricultural products and in new construction. And if the Republicans enact tax decreases, which Trump has promised to do, including no taxes on tips, no taxes on overtime, and no taxes on Social Security benefits, and the Fed lowers interest rates as inflation increases, which it very well may do, we are back to the factors that led to problematic inflation in 2021, 2022, having learned nothing as a nation from what actually caused that period of too high inflation.